How does a currency dominate 88% of the world's foreign exchange trades and still get quietly abandoned by the people who manage the world's money? Right now, somewhere in a central bank vault in Warsaw or Beijing, a reserve manager is swapping a stack of US Treasury bonds for a pallet of gold bars, one wire transfer at a time. He's not doing anything dramatic. He's not dumping dollars in a panic. He's simply choosing, quarter after quarter, to hold a little less of one asset and a little more of another. He's not alone. Central banks bought 1,045 tons of gold in 2024, the third straight year above that mark according to the World Gold Council. Call it the vault gap, the widening distance between how much a currency is traded every single day and how much of it central banks actually choose to hold for the long run. The dollar still wins the first contest by a landslide. It's quietly losing ground in the second. The easy story is de-dollarization, a coordinated global retreat from the dollar led by rivals eager to dethrone it. Except the data says almost the opposite. The rivals aren't the ones gaining. So today we're asking 4 questions. First, how big is this erosion really, and is the dollar's reserve share actually collapsing? Second, how did we get here and what's actually driving reserve managers to diversify? Third, who pays the price when a currency's home government runs a 115% debt to GDP ratio? And finally, what breaks first if none of this reverses? This matters now because the numbers just crossed thresholds that used to be theoretical. U.S. federal debt passed $37 trillion in 2025 according to U.S. Treasury fiscal data, more than the combined GDP of China and Japan, the world's second and fourth largest economies. Interest payments alone topped $1 trillion in fiscal year 2024 per the Congressional Budget Office, larger than the entire GDP of the Netherlands. That's not a rounding error. It's real money leaving the federal budget every year, before a single dollar goes to defense, healthcare, or anything else. When new Fed Chair Kevin Warsh used his first congressional testimony to promise he'd fight inflation, markets listened closely, because Fed credibility is one of the few things actually holding this system together, as Reuters and CNBC both noted in their coverage. Everyone touched by the dollar, importers, exporters, pension funds, and that reserve manager in the vault is now asking the same question the headlines are asking. Let's answer it properly. Start with the plain numbers. The dollar's share of global central bank reserves fell to about 57.4% in the fourth quarter of 2024, according to INF COFR data reported by Reuters. In 1999, that share was 71%. That's a 14-point decline across 25 years, real but slow. Track the full trajectory, 71% in 1999, 62.2% in 2010, a brief rebound to 65.7% in 2015, then 59% in 2020, 58.4% in 2022, and 57.4% by 2024. This isn't a cliff, it's a slope, and slopes are easy to ignore until someone plots them. Here's the number that should reframe the whole conversation. The dollar still sits on one side of roughly 88% of all global foreign exchange transactions, according to the Bank for International Settlements Triennial Survey. SWIFT payment data shows the dollar carrying 47 to 49% of global payment messages, still more than triple the euro's share, per figures reported by Bloomberg. Trading dominance and reserve dominance are moving on entirely different tracks. That gap is the whole story. Meanwhile, the runner-up isn't even close. The euro holds 19.8% of global reserves. The Japanese yen holds 5.8%. The British pound holds 4.8%. The Chinese yuan, the currency of the world's second largest economy, holds just 2.2%. Nobody is actually catching the dollar. Something else entirely is. That something else is gold. Central banks bought 1,045 tons of it in 2024, and gold's share of global reserves by market value rose to an estimated 20%, overtaking the euro for the first time since before the euro even existed, according to European Central Bank research cited by the Financial Times. Central banks now hold more of their reserves in gold bars than in euro notes. That reversal hasn't happened since the 1990s. You may notice a pattern forming. Why gold and not the yuan, if China is the obvious rival economy? Because reserve managers aren't shopping for a new master currency. They're shopping for an asset nobody's finance ministry can print, tax, or sanction. Gold offers that. The yuan, tightly managed and only partially convertible, does not. Which is exactly why it sits at 2.2% despite China's economic size. Now for the mechanism actually driving the diversification. US federal debt to GDP jumped from 100.2% in 2019 to 115.77% in 2024, a 15 percentage point climb in 5 years per World Bank data. Inflation rose from 1.8% in 2019 to 2.95% in 2024, a 63% increase in the rate itself. Foreign holders still park roughly $8.5 trillion in U.S. Treasury securities as of mid-2025, led by Japan and China, according to U.S. Treasury TIC data. But every reserve manager watching that $37 trillion balance sheet climb and that $1 trillion annual interest bill grow is doing the same quiet math a mortgage lender does when a borrower's income stops keeping pace with the loan. They don't stop lending. They ask for better terms, or they spread the risk elsewhere. That precisely is what buying gold alongside treasuries actually is. There's a second thread worth pulling. China and Russia now settle roughly 90% of their bilateral trade directly in rubles and yuan, bypassing the dollar entirely, according to Reuters. That's close to the same share of global trade the dollar itself commanded 25 years ago. It's a real shift. It's also a bilateral arrangement between two heavily sanctioned economies, not a template the rest of the world is rushing to copy. Here's the number that actually matters. If the dollar's reserve share keeps declining at its 25-year average pace, simple extrapolation puts it below 50% sometime in the 2030s. Whether that threshold would even matter is the real question. And the answer shows up in the next section, because it isn't the one making headlines. Picture a wealthy man, everyone still calls to guarantee every contract in town because his signature is worth more than anyone else's. That's the dollar at 88% of FX trades. Now picture his own relatives quietly moving their household savings out of the accounts he controls, not because they distrust him personally, but because his spending has started to worry them. That's the 57.4%. Signature still works everywhere. The trust inside the family is what's fraying. Who actually pays for that fraying? Not traders, not exporters. The bill lands on Washington's own borrowing costs. If a critical mass of reserve managers ever decides that 115.77% debt to GDP is the real tipping point, the US Treasury doesn't lose reserve status overnight. It simply pays a slightly higher rate to sell the next batch of bonds. Multiply a few tenths of a percentage point across $37 trillion in outstanding debt, and that $1 trillion interest bill stops being the ceiling. It becomes the floor. That's not an accident of markets. It's the mechanical consequence of the debt line moving faster than the reserve share line moves back. But, and this is worth sitting with, the American economy underneath all of this debt isn't shrinking. GDP per capita rose from roughly $65,228 in 2019 to $90,026.52 in 2025, close to a 38% climb per World Bank figures. GDP growth still sits at 2.16% for 2025. Unemployment is 4.2%, low by most historical standards. The dollar isn't losing trust because the American economy stopped producing. It's losing a little trust because the government's balance sheet grew faster than that economy did. Here's the honest, dark version of where this goes if nothing changes. Interest costs already exceed defense spending, at over $1 trillion a year per the Congressional Budget Office. Debt to GDP at 115.77% has no ceiling written into law. It can simply keep climbing, the way it did from 100.2% just 5 years earlier. If the reserve share slope holds and the debt slope holds at the same time, the two lines eventually force an uglier choice. Either the Fed accepts higher structural inflation to manage the debt, or the Treasury pays materially higher rates to keep foreign buyers interested, or both happen at once. Reserve managers don't need to abandon the dollar to make that expensive. They only need to keep buying a little more gold and a little fewer treasuries year after year, the way they already have for 3 years running. It would be easy to stop right there and leave you thinking the crown's already slipping off. But look at what's actually held steady, not what declined. The dollar's 88% share of FX trades has barely moved across the entire period. Its reserve share fell 14 points, meaning the world's actual plumbing for trade, invoicing, and settlement still runs almost entirely through dollar clearing. No currency, including the yuan at 2.2%, is remotely close to replacing that plumbing. And building an alternative, deep bond markets, open capital accounts, quartz reserve managers actually trust, takes decades, not a headline cycle. The euro tried, and 25 years later it still sits at 19.8%. Fed credibility, the exact thing Kevin Warsh spent his first testimony defending, remains the anchor reserve managers watch most closely, arguably more than the debt figure itself. That's why gold, not the yuan or the euro, is the asset actually gaining ground. It's a hedge against US fiscal choices, not a bet against the US economy. The dollar's reserve share will very likely keep drifting lower through the rest of this decade. A 25-year trend line rarely reverses on its own. But lower isn't the same as gone, and a currency crossing below 50% of reserves sometime in the 2030s, if the trend holds, would still be the single most traded currency on Earth by a wide margin. The real fix on the table isn't a new currency alliance. It's the debt line itself. Every point shaved off that 115.77% trajectory buys the dollar more runway than any gold-buying central bank can take away. So no, the yuan isn't coming for the crown, and neither is the euro, and even 90% of Sino-Russian trade settled outside the dollar hasn't dented the 88% that matters for the rest of the world. The actual threat was never a rival currency. It was always the balance sheet back home. The reserve manager swapping treasuries for gold bars isn't betting on China. He's betting that Washington's arithmetic doesn't improve, and at $37 trillion and climbing, he might be early. But he isn't wrong to hedge. Thanks for watching. Mind your reserves. This video is for educational purposes only and is not financial advice.